Welcome to America's Commercial Real Estate Show. And yes, we are celebrating 7 years coming to you around the country. We want to be your source for intel, forecasts, and success strategies. Hello, I'm Michael Bull. Today we're going to talk about multifamily. Please appreciate our sponsors out there. The sponsor for this segment is Bull Realty Asset and Occupancy Solutions. Are you ready to sell your commercial property? Visit bullrealty.com. Well, please welcome my first guest. It's Jay Parsons. He's VP for MPF Research. They're the market intelligence arm of RealPage, and he's joining us on Skype. Thanks for joining us today, Jay.
Thanks for having me, Michael.
So, Jay, the multifamily market's really been interesting. I think everyone in every sector is like, wow, multifamily's just been incredible growth. And it's like every time we turn around, we think the growth is gonna just plummet. There's too much new supply. What is the real story? What do you see for occupancy and rental rate? What's the trend? What are we seeing today?
Sure. Well, I think you teased it up well. The market is certainly not what it once was. I mean, a few years ago, everything you touched in multifamily, if you were the best operator, the worst operator, the best location, the worst location, everybody did well. Yeah. It really didn't take much of a secret formula, but that's certainly changing. And I think what's important to note now is you definitely have more pessimism out there, but I'd be very careful not to put it in a broad brush. It's not that the whole industry is all of a sudden cratering in some way. What's happening is that certain segments of the market, certain submarkets across the country are being impacted with a lot of supply, and in turn, demand's been okay in most of these spots, but just not able to keep up with the supply. And so we're seeing more vacancy and diminished rent growth, or in some cases even rent cuts in a handful of pockets. But again, there's still a lot of parts of the country, particularly suburbs and your overall Class B space, that are doing really well, and that should be emphasized as well.
What are the cities where you're seeing maybe rents starting to decline some?
Well, obviously, Houston's gotten a lot of attention. Prior to the hurricane, we'd seen rent cuts, especially in the urban core and out in the energy corridor. Now, good news for the industry, at least, is that there's been a lot of demand for units over the last few weeks. And now no one's pushing rents, of course, right now. There's a lot of sensitivity to that. But if there's one good thing about how all this played out, Houston's a market that had a lot of vacancies at the time of the hurricane occurred, and so it was able to absorb a lot of that demand for housing at a time when people really needed it. And again, what we saw is that the industry was very sensitive not to be pushing rents at that time as well. So that's a market that's obviously very unique, but certainly seeing some rent flatness or cuts in some downtown cities, downtown markets across the country.
So, Jay, what are some other cities where maybe you're seeing some challenges or maybe a great market?
Some of the challenges are going to be in those more downtown pockets, particularly in large markets across the country, Bay Area, Los Angeles, places like Nashville and the Sun Belt, where we've seen a lot of supply, downtown Nashville, that is. Conversely, we still see, I don't know if there's particular cities where we see a lot of strength outside of these late recovery markets. We're not building a whole lot. Places like Sacramento, Las Vegas, certain parts of California and Florida like Orlando. But in general, the strength is in that Class B sector pretty much all across the country, as well as in suburban areas all across the country as well. Now, one spot also I'll point out is downtown Seattle is kind of an exception to this story. A lot of supply, and there's been a lot of worry about that area given how much supply is going in, but we continue to see great demand, and so that's been the exception of the story.
Yeah. So, Jay, what do you expect for demand from tenants moving forward?
Well, there's been a lot of skepticism about demand going forward, but I think people tend to forget, particularly broader economists, is that the apartment industry has never seen a recession apart from a broader regional or national recession. So demand is not going to erode just for no reason. Now, if we hit a national recession or recession in certain parts of the country, sure, you're going to see less demand. But if you're bullish or at least moderately bullish on the economy overall, you should be pretty bullish about apartment demand overall, because the demographic trends and overall housing trends continue to suggest that we're going to see plenty of demand out there. So the real question is, can demand keep pace with supply? And we don't think it will, at least for the next 12 months or so on a macro basis.
Okay. So when you look at the country overall and you look at all asset classes of multifamily, what are you seeing for rental rate and occupancy trend?
Great question. So rent growth year over year on a same store basis, we have in the high twos, around 2.7% through third quarter. Quarter over quarter, just under 1% growth. So still definitely pretty solid growth, about average or a little slightly above average compared to the long-term norms. Now, across the country, as mentioned earlier, we see a wide variance. The gap between the best and the worst markets and submarkets is much larger than it was a few years ago. In terms of the classes, again, that strength is going to be really in that Class B sector. We're seeing still rent growth above 3 to 4%. Class A is going to be a little bit weaker. However, if you're Class A suburban, you're still seeing really good growth, and that's because it's much harder to build in those high-end suburban areas. You run into NIMBYism and restrictive zoning and all that kind of stuff.
Okay. And Jay, where do you see the most promise for multifamily growth in occupancy and rents in certain markets? Are there certain markets that maybe have been supply constrained, that maybe are some opportunities if you can build in today or buy in?
Absolutely. Now, on occupancy, there's probably not room for much growth. The B and the C sectors are full. You really can't get much more full. Class A will continue to be challenged with supply, so I don't think occupancy is going to get any better in most spots. On rental rate growth, I still think there's potential to grow in. We continue to look at those high-end suburbs in Atlanta, places like Alpharetta, and Dallas, places like Plano. These kind of high-end pockets where it's really hard to build. In fact, I mentioned Plano. Many of y'all know Plano, one of the big suburbs across the country, high home prices, proximity to jobs, et cetera. And this is a spot that just ran through a city council election where there are billboards and yard signs saying no more apartments. And these are the kind of spots that have those urban-like demand drivers. So people really don't want more apartments. And so because of that, I think that really well positions those who do have a deal in that area already or are able to get that site approved.
Well, Jay, are there any concerns that the apartment industry should have right now? Anything on the horizon we may want to watch out for?
Well, beyond supply in the urban spots we mentioned earlier, the big question is what happens in our broader economy. Obviously, if there's a slowdown, that's going to impact demand at a time when we really need demand to feed all the supply. So, it's become trendy among economists to forecast a recession. Most people tend to say it's 2 years out, but they've been saying that for the last 5-6 years, and it hasn't happened yet.
Always 2 years out.
At some point it will.
You're right.
Yeah, it's always 2 years out. Now, at some point it'll occur, but I think that's the big question going forward.
Okay. What about opportunities? Where do you see opportunities for the apartment investors or developers today?
Well, as I mentioned earlier, if you could get into those high-end suburbs that have very restricted zoning laws, if you get into those spots, that's the best bet. Outside of that, the value add is still a big play. If you can target, again, those high-end suburbs, you're not running into affordability challenges. You are going to be able to justify getting much higher rents, taking those 80s and 90s properties and doing a big value add on those. The other spots is we've seen some opportunity is for those who want to get more into the B and C plus sort of space. You get into those working class suburbs and growth markets where we see a lot of demand, but just not the ability to go to those higher price points. In certain spots, you can justify those deals, but it's definitely getting to a point in the cycle where you really have to get to the right submarkets, right street corners to make for it to make sense.
Yeah, those are very good points and good tips. And we did a show recently, and we'll put links on it below, that zoning for fun and profit. And we talked a lot about taking some of these maybe older communities and rezoning them, or rezoning some of these retail properties that maybe are having a challenge in doing multifamily. And I agree, if you can get in these markets where maybe they're trying to constrain supply, they don't want any more new apartments, some real upside. Jay, great information as usual. Thank you for joining us today.
My pleasure. Thank you, Michael.
If you'd like some more information from Jay, visit their website. It's realpage.com. And stay with us. We're going to have more on the apartment industry. I'm Michael Bull. This is America's Commercial Real Estate Show.